What do you do next year? Obviously, no one's predicting that the gains are going to be as big next year, but what do you do in terms of your money? Are you holding on to stocks? Are you diversifying more into other assets that perhaps haven't performed as well? Yeah. Let's start with you, James.
Yeah, so the key is that this was quite a titillating year for all investors. You had all asset classes really outperform. And in fact, you could argue this is the best year of the entire cycle, with essentially both fixed income, international stocks, and U.S. stocks doing really well. You look at why that happened, and it's because, one, the recession that many feared did not occur, and you also had the Fed really fueling a lot of these asset classes. And going forward, unfortunately, those factors probably aren't going to help us much. So it's going to go back to just plain old earnings growth, plain old economic growth, especially if manufacturing can bounce back, if other international market economic stories can bounce back. And if that can occur, maybe we get about 5, 6, maybe 7% earnings growth. Probably not the 10% earnings growth that the market expects, but still solid growth from there.
James mentioned earnings growth, and valuations have obviously crept up this year. So are we going to see that come to fruition next year? Are the fundamentals going to be there?
I think so. I think when we take a look at some of these surveys coming out of Europe, we're starting to see some optimism. If we do see a global reacceleration, I think there's going to be further upside here for earnings outlooks. And I think when we take a look at what happened last year, when we were coming into 2019, expectations were maybe we'll see about a 10, 11% gain. We're practically at 30%. I think that right now everyone is being a little bit conservative, myself included, in targeting what we're going to see as far as equities growth for next year, and we probably could be surprised at the upside.
And conservative would mean single-digit gains, right?
Yes.
So then let's talk about the concerns then. Could markets perhaps be complacent? Certain number of risk factors. Certainly next year, you're in an election year. You've also, the U.S.-China trade war may have eased a little bit, but still there. We don't know what's going to happen. So, James, what are you looking at? What could actually throw off next year? Yeah,
so we do think there is some complacency here. Unlike last year, where you can almost argue you had a bear market or recession in expectations, which, of course, did not play out the way many people had feared it would last year. This year, it's kind of swung the entire direction altogether. A lot of what you saw this year was just multiple expansion. Valuations driving a lot of what you saw with all the returns around the world. And so where we are now today is that very few people expect a recession over the next 12 to 24 months. Very few people expect even a pullback in the market. And of course, that is unsustainable. So I think it goes back to what you just mentioned, Deirdre, that you probably will get back to probably about a single digit, maybe high single digit expected return. And of course, that goes back to what happens with earnings growth and economic growth around the world, but we should really be ratcheting back those expectations from what was a really stellar year.
Now, Ed, I spend most of my time in San Francisco, so I've been looking at valuations through a very different lens. Some of the most anticipated IPO names to go public this year haven't performed quite as well. What do you see for the IPO environment next year, if you can speak to that?
I think, well, this year was a tough year for IPOs. I think we had many disappointments, and I think that you're going to see, as markets have shown some signs of stabilization, that you're going to see other companies want to come to the markets. I think that there's growing risks to the outlook for IPOs. We need to see revenues. We need to see profits sooner than later. I think you can't have this bucket wish list of promises and expected growth down the road. You have to be delivering results sooner, and I think that's going to kind of change the way IPOs are unveiled in the future.
And James, what's your outlook on this market? Are we going to see, there's names that have to go out. We still have a bunch of unicorns that have been private for much longer than in the past. We used to see them go private. What do you think is going to happen?
Yeah, so you have this interesting dichotomy. At a macro level, you have all this private capital. Of course, private investments have been just this huge growth area for the asset management industry. And, for good reason. You can't just be looking at the public markets, especially with the private markets being such a large component now. But on the other hand, you have how these companies have been run. And to your point about the IPOs so far this year, and clearly the issues around SoftBank and WeWork, a lot of that was governance. It was about getting eyeballs and transparency into these companies, and also not just focusing purely on top-line numbers, but to think down the line at profitability. So clearly there's some dynamic that's going to have to shift, especially in the startup space, especially closer to IPO. But we still expect a lot of private money to be in the space over the next few years.
Do both your models anticipate that President Trump is going to serve another term, just briefly?
So we don't make election forecasts per se, but what I would say about elections in general, especially with the impact to markets, is that presidents probably get too much credit for the economic situations and the markets that result from that, and vice versa as well when markets go the other direction.
Ed, what about yourself? I mean, not necessarily will he be reelected, but if a Democratic candidate, particularly a more left-wing one, does win the nomination, does that throw off your prediction for next year?
I think election uncertainty is going to play a huge role in where the markets end up next year. And when we take a look at right now, Wall Street is firmly pricing in a Trump re-election. I think that there are surprises that we could start to see unfold closer to March when we have the more one-third of the populace start to vote. You're probably going to see a progressive not get the nomination. I think Bloomberg, Biden, Buttigieg are probably going to get the nominee. And the more interesting number that I've noticed is that over the last couple of weeks, we've seen Biden maintain a strong lead in these battleground states, Wisconsin, Ohio, Michigan, and Pennsylvania. And if that's the case, these are the battleground states. So we might see the market start to price in possibly a little bit of a risk that a Democratic could come out. And if that's the case, that might hurt a little bit some of this growth that everyone is targeting.